Did you go there after? Yeah, I went there after. Just like,
Hello.
how you guys doing?
How are you doing?
Well, pretty well. Actually, I did hear that the tech group in IB, specifically in the Americas, is pretty safe. Specifically, so I'm not going to be out of a job. Apparently, the team Friday. So what I'm more worried about is that it's still going on. Probably not. Probably just gonna fire. Yeah, well, good thing private equity is free. I'm they ended up selling it at 3 point. Always found. Yeah.
Welcome back. Start the class, I said valuation is always interesting. Things always happen. What can happen in a week? The week we've been gone quite a lot, right? Anybody valuing Silicon Valley Bank? No. If you were, then I think this is one of those cases where I ask you to change your company now because there's really no point. How many of you are valuing banks in general? Somebody must be valuing banks. No, nobody? Now, even if it's not Silicon Valley Bank, the game changed. But even if you're not valuing a bank, you think the game has changed in the last 10 days? All kinds of other risks are coming up to the surface. I mean, what, no, let's spend a couple of minutes on Silicon Valley. What was their cardinal sin? I mean, you're a Catholic, cardinal sins are the sin you can't confess to every Sunday, right? This is the kind of sin you're beyond redemption. What was their cardinal sin? What was the sin that brought them down?
They kind of like match their customer deposits with like mortgage-backed securities.
And what's wrong with that?
There's like a tenor mismatch because a customer can come in
That's
and
basically it, right? I mean, what they invested in was, you consider it pretty safe. The mortgage-backed securities they bought were highly rated. They bought a lot of treasury bonds. The problem was they bought 10, 20-year securities with deposits that were either demand deposits or short-term fixed rate deposits. They had a duration mismatch. In my corporate finance class, I talk about this as one of those first principles you don't violate because sooner or later it catches up with you. Now, why did they do it though? And these are not stupid people, I would assume. So what, I mean, remember, much of this happened in 2020 and 2021. So why would they take deposits and invest it in T-bonds? What drew them to these long-term securities? I'm going to stay with you. So what was it that led them to do this?
well, I think just like they were having a tough time sourcing VC projects, so they weren't like getting sufficient returns on those.
But why did they buy short-term T-bills? What were short-term T-bill rates like in 2000 and 2001? Close to 0%, right? They did it for a simple reason, which is they said these deposits are effectively free. We're paying almost nothing on it. We can invest at 1.7%. We're going to keep the spread. This is how violations get born. It looks easy. And then the whole thing blew up, of course, in 2022 because long-term rates went to 4%. And what I mean, we talked about estimating the market value of a bond. Remember, I said you can convert book value of debt to market value of debt. You take the book value of the treasury bonds of about 91 billion, but that book value is based on a 1.7% rate that they bought those bonds at. The rate on these bonds has gone from 1.7 to 4%. You revalue those bonds, what's going to happen to the value of these bonds? Go down or go up? They're going to go down, they drop by about 18 billion. That's at the source of this problem. They have an $18 billion hole that was not recognized because in the accounting terms, they kept it at book value until they could not do it anymore. It goes back to first principles. If you violate first principles, things will always catch up. I mean, there's actually a variant of this called the carry trade. Now, a lot of hedge funds claim to use. What's a carry trade? If somebody describe to me how you make money in a carry trade, what do you do? Usually involves two different currencies. You borrow money in a low interest rate currency, like the Japanese yen. You invest it in a higher interest rate currency like the US dollars. Right now, the 10-year Japanese government bond rate is 1%. You borrowed 1%. You invested in T-bonds at 4%. This seems like easy money, right? It's one of the stupidest rates you can think of because you're assuming that there's no good reason why the rates are different and that exchange rates won't make up. Most of the time, you get away with it. That's why it's so alluring. It's 95 times out of 100, you make money. But you know what the danger is? When it blows up, it takes out all 100 years of profits plus more. It's catastrophic. I call these strategies, this cute strategy. They win most of the time, but when you lose in catastrophic amounts. So keep that in mind as you look at people saying it's easy money to be made. There is no easy money to be made anywhere in markets. Take that as a given. So when somebody says it's easy money to be made, they either haven't looked hard enough or they don't know what to do. There's always a catch, and you got to look through what that catch is. Finally, who did Silicon Valley cater to? What is that primer? Startups, the startup ecosystem, who's in it? VCs, founders, and the most virally connected group you can think of, right? Did it help them while they grew? Absolutely, because they virally fed each other. I put my money in Silicon Valley Bank. Are you going to do it too? Life is full of trade-offs. The same forces that allowed them to grow fast turned against them over a period of 48 hours. Now, and this is the irony. The trigger to this whole meltdown was Silicon Valley actually trying to do the right thing, which is they wanted to take some of their losses, in fact, sell off $20 billion of the bonds, which would create a $3 billion loss, but they were going to issue $3 billion of equity to kind of bring themselves to a better capital. Good thing to do, right? But they mangled the whole offering because word of the offering leaked out before the actual offering was done. And the minute people found out, I mean, this isn't like lending to 50,000 farmers who are too busy doing real things. These are 50,000 VCs who have nothing better to do than check their phones, right? Their entire business is built on checking their phones and connecting to other people. Of course, they talk to each other. They all decided to withdraw money over a period of 24 hours. And the rest, as they say, is history. It's bad history, but it's history. The problem is when Silicon Valley Bank fell, it was like multiple forces came together to bring them down. It's perfect storm. But once Silicon Valley fell, then of course you get the ripple effects. It was Signature Bank, now it's First Republic. By Wednesday or Thursday, First Republic is probably going to be acquired by somebody because once that debt spiral starts, what can you do to stop it, right? You can't talk it off. You can't talk investors off the ledge, depositors off the ledge. The question is, will it stop at First Republic or will it find the next target? You can already see that each new target is essentially lined up already to go. CSFB, of course, went over the weekend. Yes.
Do you think that if Silicon Valley Bank marked their long-term assets to market instead of to the holding period, the collapse would have happened sooner?
It might have, but it might have been, I mean, in a sense, did everybody get the question? One of the things that Silicon Valley Bank did was allowed to classify these securities as hold to maturity, which meant that you could show them at book value or face value, and they didn't have to show the losses as they had. And this is actually one of those interesting questions about mark to market. This is one of those few places where I think it's worth debating. On the one hand, it might have allowed depositors more transparency about what was happening, and maybe you wouldn't have had the rush of deposits. But on the other hand, mark to market can create its own debt spiral, right? And this is something we discovered in the aftermath of 2008, is when hedge funds marked the market, it actually made the crisis worse. So I'm not sure you could have avoided the crisis. The original set, it's still the original set, right? It's not going to go away. So it might have happened sooner, it might have been more gradual, maybe they'd have found a cushion, maybe they'd have found a buyer. But I think that in this case, you can debate, but once you created that original problem, there's no easy way around it. One way or the other, you have an elephant in the room you got to deal with. Okay, so today we're going to really talk about connecting stories to numbers. And this is going to relate very closely to what you will be turning in if you choose to for feedback next week. So we're going to talk about the importance of stories and valuation. And the point I want to make is, even if you never told a story, if you've done traditional valuation, Excel spreadsheets, I've never had to tell a story. The reality is implicitly, you're always telling a story. Let me give you an example. Let's assume that you're looking at an Excel spreadsheet. It's a traditional banking spreadsheet, and you have an analyst who's projecting a growth rate of 50%, compounded annual growth rate, 50% for the next 10 years, an operating margin of 20% in year 10, which is twice the industry average, a low reinvestment given the growth, and a cost of capital of 7%. So all you see are the numbers. You're seeing this high growth rate, a margin much higher than the industry average, very low reinvestment, and a low cost of capital. Is this analyst telling you a story about the company, even though they might? So let me list out the stories and you tell me what you think the analyst is telling you about the company. So first, is the company's size right now, is it a small company or a big company? It has to be small. 50% compounded annual growth would blow up the company otherwise. Is the total market stable or growing? It has to be growing, because it's a stable market. You have a 50% growth rate. Guess what you have to do? You have to take market share away from other people. You're saying, what's wrong with that? Well, the fact that he's assuming that margins will go up while assuming high growth must mean that the market is big enough and growing fast enough. What kind of competitive advantages are you assuming for the company? Strong or weak? They've been really strong. And in terms of capital intensity of the business, low capital intensity, low capital intensity. And finally, is the nature of the product discretionary or non-discretionary? What gives it away? What's he using as a cost of capital? A really low cost of capital. The fact is, you see where you probe, when you, if you debate numbers in a spreadsheet, you've already lost this graph. So you say, why are you using 50%? Why not 40%? You're conceding the game. The questions you need to ask when you look at evaluation are not so much about the numbers, but about the underlying assumptions. Is the market growing or is it stable? You bet. So that's where you get the weakest links in valuation, when people are using numbers that are not backed up by stories that are justifying the numbers. So let's assume you've told a value, you've come up with a valuation, you've told a story. I'm going to ask you some questions about what might cause your story to change. So in other words, you turn in your valuation next week, you feel pretty good. I'd say it looks good. What could cause your valuation to change between next week and May 8th, which is when the final program? Could an earnings report about the company change your story? Sure, right? Most of the time it doesn't. It might have small, but it could change your story. What about macroeconomic factors? Hey, look at what's happening around. It could change your story. Regulatory changes. If you're in a business that's regulated, a regulatory change could do it. Earnings reports from other companies in your sector. You're in a, let's say you're a ride-sharing company. You're looking at Uber, and Lyft comes out with an earnings report that's terrible. Whether you like it or not, you might have to reassess what you think about your company. This is bad news. Basically, your valuation is going to change every moment of every day after you turn it in, and it's going to keep changing after May 8th. But guess what? The market price is also changing. So complaining about the fact that things are changing is neither here nor there. It's a given. It's a feature of valuation. So get ready for some volatility, especially in the market for it. And finally, let's talk about life cycle. I gave you the corporate life cycle. Startup is like a baby, then you toddlers, and teenagers, and mature companies, and declining companies. Every valuation is a mix of stories and numbers. I'd like you to tell me what the mix will look like as you go through the life cycle. The first choice is the mix shouldn't change. You have the same mix of stories and numbers, no matter where you are in the life cycle. Maybe the numbers are more important for young companies and stories for older companies, or maybe it's a reverse. And why? Why is that? So also everything is in the future, right? There's nothing there. So you have the numbers, but it's not that the numbers don't back you up, but the numbers reflect what they've already done. They haven't done much. Your stories are going to matter a great deal more if you have young growth companies. Whereas mature companies, you can get away being a spreadsheet ninja, right? You can take historical data projected out. You value Coca-Cola. It's not much of a, how much divergence in story can you get? The story, I mean, the way I described it, you're in chapter 33 of a 35 chapter book, right? There's not a whole lot you can do to change the characters. If you're a young company, be ready to tell stories. So don't be too hard on yourself and say, look, I could be wrong. I'll save you the trouble. You're definitely wrong. And it's okay. Because everybody else is trying. They're all going to make mistakes. It's all about the future. So today, as I said, we're going to spend a lot of time in stories and numbers, but there's one loose end that we still have to tie up on. There's our friend again. He promised me he'd be in class. So next class, I'm going to hold him to it. We were talking about stock-based compensation. Remember what we said about stock-based compensation? It is part of compensation. It is an expense. It should lower your income. And we're talking about the best ways to deal with management options. We value them as often using option pricing model. The pushback you would get, of course, is that traditional option pricing models were never designed for employee options because employee options are long-term. The listed options and traditional option pricing models value are short-term. Traditional options, listed options, the option exchange, when you win, somebody else loses, the company's not involved. So when you buy a call option in the Chicago Board of Options and you exercise it, there are no new shares created. It's somebody else losing. So there's a winner and loser. As opposed to employee option, when you exercise an option, you can actually change the share count and affect the stock price. And there's one final aspect of employee option that makes them tricky to value the option pricing. Let's say you buy a call option on First Republic right now. Why? Because you think the worst is over. They're going to come out of it. You could be wrong, but let's say you're right. It's a 3-month option, and over the next 2 weeks, First Republic stock price goes up 50%. You made the right guess, right? 2 weeks from now, remember, you still have a couple of months left of the option. Would you exercise the option, or is there a better choice? What would you do instead? You'd sell. Why? Because you always get the time premium. So with listed options, you almost never get early exercise. You see, so most option pricing models are designed to value what are called European options. Unfortunate choice of term because it's got nothing to do with geography. What separates European options from American options? You can have exercise only at expiration. So when you do listed options, we use the Black-Scholes model, we get away with it because the Black-Scholes model is designed for European options. But let's say you're an employee of a company, let's say it's Tesla. And let's say you got your options when the market cap was 100 billion. Remember what the market cap rose to, right? 1.2 trillion. So you got these options, the market cap's gone to 1.2 trillion. You think it's too good to be true. Can you sell your options with employee options? No, you can't sell them. You're stuck with it. So if you think the market price is too high, what are you going to do then? You're going to exercise the option. Employee options are more likely to be exercised early. So unlike listed options where 98% of options get held through expiration, with employee options, you get exercised halfway through, 60% of the way through. And that was the excuse that accountants gave for a long time for not using option pricing models to value employee options. They're too long term, there's dilution, and the maturity might be much shorter than the actual end. But those are fixable problems. So about 15, 20 years ago, people started taking traditional option pricing models and adapting them to value employee options. And that's what I'm going to do. I'm going to take, remember the 10 million options that I gave the CEO, which are at the money? I'm going to use an option pricing model, but I'm going to adapt an option pricing model to reflect the fact that these are not listed options, they're employee options. Here are the adaptations. First, The stock price is actually $10, but instead of using a $10 stock price, I use a dilution adjusted price, where I say that because of these options, there's a dilution effect. And it's actually a pretty mechanical calculation. The price I use is $9.58, even though the actual price is $10. Let me pause right there. By using a lower stock price than the actual stock price, what am I going to do to the value of the option? I'm going to lower the value of the option because the actual stock price is 10. That's a dilution adjustment. Second, I have a 10-year life on the option. If I really am worried about early exercise, I could use a 5 or a 6-year life, even though the stated life is 10 years. In other words, I can take option pricing models and adapt them for the fact that employee options are different. And using that adapted model, the value that I get per option is $5.42. These are at the money options, but right now valued as options, they're worth $5. That's a time premium on the option. So when I gave 10 million options to my CEO, what did I effectively give him in terms of compensation? 10 million times $5.42 per option, gives me 54.2 million. Who paid for it? You did as equity investment. So here's what I'm going to do. I'm going to take the value of equity that I got, subtract out the value of the options, saying that was my equity you gave away to the CEO, which gives me a lower value for the equity. And I divide what's left by the actual number of shares outstanding. The reason I emphasize that is don't double count. You know what double counting would involve? Adjusting the share count for what the future. So don't bring in the 10 million options that might or might not be exercised. I've dealt with the option by valuing the options. I've reduced the value of equity. The value per share that I'm going to get is $9.46. So the stock that was trading at $10 before I made this announcement that I was giving the CEO 10 million options, 1 second after the announcement, the stock price is going to be down to $9.46 because I've given away effectively $54.2 million for the option. This is what accountants are now doing when you have option grants. Is they're valuing the options using an option pricing model, is showing it as an expense in the year you grant it. And that's the right thing to do. But to show you that doing the right thing doesn't always lead to the right practice, what are analysts doing to counter this? With stock-based compensation. So accountants go to all this trouble of valuing option grants as expenses, reducing your earnings for stock-based compensation. What are analysts doing that kind of reverses the process? They add back the stock. You can lead a horse to the water, but you can't make it drink. You're doing the right thing by expensing options, but accountants are reversing all of their hard work, and they do the same thing with leases. Sometimes I wonder why accountants or any of us try to do the right thing. Stupidity seems to be built deep into the structure, and people keep doing the same things they do over and over again. So let's be quite clear. Options are expenses, like everything else. They reduce your income. And this just deals with options from the past. And what else is there to deal with? Is your company done granting options on restricted stock? Not necessarily, right? To the extent that a company might grant options in the future, give restricted stock in the future, you have to reduce future income for those future grants. And people say, isn't that double counting? You're reducing the value of the equity. No, it's for two separate effects. When I reduce the value of effect for existing options, I'm bringing in the dead weight cost of what you've done in the past. When I reduce your future earnings, it's for what I expect you to do in the future. And you can see there are companies like Cisco, where you're going to affect them in both places, because Cisco has granted a lot of options in the past, and it continues to grant options now. Amazon used to grant a lot of options in the past, but it doesn't grant much in stock-based compensation anymore. Why? Because it has the cash to pay employees. So you can see that you can have one problem for some companies, the other problem for other companies, and both problems for some companies. And this takes care of both problems. So I want to stop, pause, and ask about stock-based compensation. So it can take the form of options or restricted stock. Restricted stock is relatively straightforward. Just adjust the share count. Options are a little messy. You've got to value the options, reduce the value of equity, and then divide by the actual number of shares outstanding. Either way, you're reducing your equity value when you grant options to your employees or restricted stock. So now let's turn to what one of the themes I started this class with. I describe valuation as a bridge between stories and numbers. And I also made the confession that when I first started teaching this class, I taught it like a number cruncher. which is I focus on the numbers, I focus on equations, I focus on Excel spreadsheets, or the equivalent model. I learned pretty early in this process that that was a mistake. Because when you feed, if you're a number cruncher and you feed into numbers, you feed your delusions about precision and being objective. So I argued that whatever your weak side is, you need to bring it in because a good valuation requires both sides to be working there. So I had to teach myself storytelling. And I started in the 90s, and I would be lying if I said it was easy, because when I first started trying to bring story to valuation, every fiber in my body fought it. And I don't do it. This is a sign of weakness. So I'm going to take you through a 5-step process that I use when I value companies. And I force myself to go through these 5 steps, because if I don't, I'll end up in a spreadsheet grinding through numbers, because that's where my natural instincts are going to take. This 5-step process, you can come up with your own process for bringing in both sides, but this works for me. It might not work for you. So the first step when I want to value a company is I describe this as, the way I describe it is assessing the landscape, looking at the landscape of companies, which is a fancy way of saying, to value a company, you need to know what your company does. You need to know what market it's in. You need to know who its competitors. If you don't do that, you can't value it. So assessing the landscape means recognizing what your company does, who your customers are, what it does well, what it does badly. So I'm going to use a company to illustrate this process. And it's a company that I think I learned a great deal about storytelling by value. This is my first experience with Value Uber in June of 2013. I'll set the stage. It was a Wall Street Journal story that drew my attention to Uber. The story basically said a company called Uber had raised $3 billion from venture capitalists and priced the company at $17 billion. Notice the word I use, price the company, right? Because we talk about how VCs don't value companies. And I was surprised. I was surprised because I'd never heard Uber. So were you living underground? Effectively, I was. I took the subway everywhere. I never took car service. So I didn't really know what Uber did. And let me take that back. I said I'd never heard of Uber before I read this news story. That was not technically true. I'd seen the word Uber show up on my credit card statements in the 3 months leading into June of 2014 when I saw the news story. Because it turned out that my son was going to college in North Carolina, was using Uber and using my credit card to back it up. I don't know how that happened. But I thought he was taking German language classes. The no umlaut on the U should have kind of given it away, but no. So I read the story about a $17 billion pricing, and I decide I want to value. And I know nothing about the company. So guess who I called first? I called my son, but he was still sleeping. It was 11:30 in the morning. He kept what I call college student hours, which basically means it's got nothing to do with the sun coming up and the sun going down. It's a different clock altogether. It's like you're in a different time zone. And he wouldn't pick up his phone. So I decided to call my niece, who is technically awake because she had a job. So she had to be awake. But she was in a horrible mood. She picks up the phone and says, "What do you want?" This is how she greets her favorite uncle. And I say, "Have you heard of this company called Uber?" He said, "It's a ride-sharing company." I said, "What the heck is a ride-sharing company?" She said, "I don't have the time to tell you what it is. Why don't you download the app and find out for yourself?" Hangs up the phone. Talk to a mother about this behavior, but no, I had to wait. So I download the app sitting upstairs in my office. I hit the app, magical things start to happen on my phone, and GPS opens up. And I see a car trying to get to me. Why? In New York City, you don't get from point A to point B, you just try. You zig and you zag, and all kinds of streets are blocked off. You can see the car zigging and zagging, and I can see the name George, the car, the driver. I've never seen this with a yellow cab. I'm fascinated. So 15 minutes later, George and his car pull up in front of 44 West 4th Street, and I say, "Hi, George. This is where do you want to go? You didn't enter a destination." I said, "Nowhere in particular. But could you drive me around for about 30 minutes? I have some questions to ask." He thought I was a serial killer but then he said, "You're too small, you can't hurt me. Get in the back, Jeffrey Dahmer." So, and I started asking questions. I said, "Is it the Uber car you're driving?" He said, "No, this is my car." I said, "Are you an Uber employee?" He said, "I'm an independent contractor."
I said, why do you do this? He said, I have a job, but I don't make enough money. I already own this car. This allows me to earn a second income to supplement my basic. I said, why do you need Uber? He said, in New York City, it's illegal to stop on the streets and offer somebody a ride. That's actually true. There's gypsy cab rules that were written 100 years ago. He said, Uber connects me with customers. I said, that's interesting. So 30 minutes later, he drops me off. I offered to pay him. He says, no, you don't have to pay me. I said, it's free. He said, no, it's not free. You downloaded the app. They ask you for a credit card. I said, yes. They'll charge. I said, how do you get paid? He said, they'll send me 80% of the fare. I said, why 80%? He said, I don't know. That's what they order. And he drives off. At this stage, I can see why this guy used Uber, because it allowed him to connect to customers on a second income. I could see why Uber did what they did. They got to keep 20% of the fare for being an intermediary, which left me with one final leg. Why did my son and my niece like Uber so much? So I decided to call my son again. This time at a civilized hour, like 3:30 in the afternoon. No more excuses for still sleeping in. He's awake, and I decided to put him on the defensive right away. I acted like I knew what Uber was right from the beginning, even though I didn't say. I noticed you're using a ride-sharing app and using my credit card to back it up. Why do you need ride-sharing if you have a car with you? He actually owned a car. He said, Dad, on Friday nights and Saturday nights, I really like Uber. As a parent, there's some follow-up questions you don't ask, but I kind of got it. But this is a kid who could not, it's not even in his frame of reference to hail a yellow cab. I can't even see him on the streets. I said, what do you like about Uber? He said, I can call the car from the bar. I said, that's a plus. I said, but you must wait forever, right? He said, no, it's come sooner than a cab. I said, really? It must cost a lot, right? He said, they're cheaper than a cab. The cars must be filthy, right? They're cleaner than a cab. I said, let me get this straight. They come sooner than a cab. They're cheaper than a cab. They're cleaner than a cab. That's what I knew cab service was destined for doom. Which left me with one final question. What's so special about Uber? They're an intermediary. Why couldn't I get a powerful computer, put it in my basement and connect customers to cars? I could think of two things that Uber had that I did not. One was $3 billion. They had it, I did not, a little bit of a disadvantage. The second is, this is a business with networking benefits. People use this as a buzzword. But what's the essence of a business with networking? No. Benefits. Yeah. Well, you can say that about any business. So, but usually as companies get larger, it gets more difficult to keep, because the easiest customers get first. As you get larger, it gets more difficult to add customers, right? But if you're in a business with networking benefits, what's so, and this is actually in Silicon Valley, you see this in this circle that they draw. Here's how it works. As you get bigger, it actually gets easier to get bigger. Here's what. If you're a driver and you want to drive for a ride-sharing company, and I give you two choices. You can go with this leading ride-sharing company, the startup ride-sharing company. Which one are you going to drive for? You're going to go where the customers are, which is, and if you're a customer downloading an app for a ride-sharing company, guess which one you're going to go to? You're going to go with the big, so the larger you get, the easier it gets to grow. The networking benefits, and they were first in the game, so they had the networking benefits. That was my research on it. You say, why do you look at the financials? What financials? When I first learned about Uber, they were a private company, a remarkably opaque private company where there are very few numbers available in the company. All I knew about Uber was their gross billings in the most recent year and how much money they lost. That's it. But let's assume I'd had all of their financials. What would I have learned about Uber that would give me some special insight? You know what I'd have seen? Small revenues, big losses, we're still building up. There's very little, for those of you valuing young companies and you're spending all of your time reading their last 10K and annual report, just stop. There's not much you're going to learn by poring over those numbers, because there's not much there. That was my start to this process, is setting the landscape. This is what the company is, this is what it does. And this is the business it's in, it's the car service business. It's not a new business, it's been around, they just changed the way the business is run. Second stop in the process. I need to, so when I got done with learning what I did about Uber by talking to my son, my niece, and Uber drivers around the world, I drew a picture. I tried to do this, and you saw this, my attempt at Silicon Valley. I find that drawing a picture gives me a little more clarity on connections between the different things that are happening. This is the picture I drew for Uber, and basically there's no rocket science here. I'm talking about how Uber makes money, why drivers like it, why customers like it, what sets Uber apart from the competition. Second stop in the process, I am going to try to tell a story about Uber. And let me remind you, this is a business story you're telling. You're not a creative novelist. Don't create characters who wander on and wander off for no reason at all. Keep it simple. I'll tell you what I don't want to see as your story. I don't want to see Game of Thrones. You don't have 8 seasons and 80 episodes to tell your story. You have 15 minutes. You want to keep it simple and you want to keep it focused. What's the end game for every business? No matter what kind of business you have, what's your end game? What do you have to convince me as an investor you thought about? Or at least a pathway to making money. It doesn't have to be strong. It doesn't have to be, at least tell me you've thought about the possibility of making money. Is that asking for too much? Be amazed at how many startup founders I've talked to. Usually there's some kind of a tech geek who talks about how neat their app is and how many people have downloaded. In about 20 minutes in the pitch, you put up your hand and say, have you thought about how you plan to make money? They brush up. Let me talk about how neat the app is and how many people download it. At least tell me you've thought about, whether you want to do ads or subscriptions. At least, so right now I know you're losing money. You're still a startup, but at least I need to get a sense of here's the pathway that I can see to make money. Keep it focused. And finally, stay grounded in reality. So when you tell a story, I'm going to make sure that you're not telling me a fairy tale, because as a founder, you have this incentive to make your story big and grand and amazing. And it's my job to be the Kevin O'Leary of this universe, saying, bring you back. No, I'm not going to talk about licensing deals, but you know what I'm talking about. Basically talk about, hey, this is what the world looks like. And this is, the story you're telling. Tell me that your story is based in reality. So you ready for my Uber story? Based on what I learned. This is a story I told for Uber in June of 2014. You say, why is the timing so critical? I value Uber pretty much every year since June of 2014. Do you think my story has changed for Uber? Of course it has. Why has it changed? Because the world has changed. I'll talk about some of the things that triggered my change in Uber stories. So I make no apologies in hindsight for saying, oh, you know what, that story was bad. At the time that I told the story, this is what I thought about Uber. So in my story, I described Uber as an urban car service company. Every word here is going to have consequences. What does the urban mean? I see Uber succeeding in cities and big towns as a car service business, which will bring in new users into that business. People like my son and my niece who might never have taken a yellow cab are more likely to take. So it's going to bring in new users with local networking benefits. I already talked about networking benefits. Uber becomes the largest ride-sharing company in New York. There's going to be a tipping point where it becomes the dominant ride-sharing company. Saying, what's a local doing? In my story, Uber can end up dominating New York. Lyft can take Chicago. Didi can take Beijing. Ola can take Mumbai, and Grab can take Kuala Lumpur. So in my story, you can have 8 or 9 different ride-sharing companies in different parts of the world, and that's going to have consequence in terms of what kind of market share I can give. What's the opposite of local? You can have global networking benefits, right? Facebook and Google have global networking benefits. There you get a market share of the total market. My story was local networking benefits. And I did assume in 2014 that Uber could keep doing what they were doing, which is keep 20% of the revenues. Completely arbitrary, right? How do you think Travis Kalanick came up with 20%? Travis Kalanick is the founder of Uber. I'm sure he was at dinner one night with a venture capitalist that he was trying to raise money from. The check came, and knowing Travis, he got the VC to pick up the investor to pick up the check. The investor wrote a 20% tip. Travis said, you know what, that sounds good. Let's pick 20%. There's no good reason, but once you pick it, it sticks, and I'm assuming it's going to stay at 20%. And I'm going to assume that they're going to keep doing what they do, which is not own the cars and not hire the drivers. That was my June 2014 story. You're going to see it play out in the numbers. Now, before I convert the story into numbers, there's a stop I've got to make. I've got to make sure the story I'm telling you is grounded in reality. I have what I call the 3 P's. First, is it possible? Second test, is it plausible? Third test, is it probable? Sounds like I'm playing on words, right? Possible, plausible, probable. We lay the groundwork. Lots of things are possible, a subset are plausible, and even smaller subset are probable. Possible means somebody has done something like this somewhere before. Plausible means you got to offer me something more, some more ammunition to build, and probable means you can show me some numbers, a city that it's worked in, a pilot market that you've gone at. I've wrestled with ways of drawing a contrast between these 3 words, and I'll give you what's worked for me best. It was, I think, late in 2017. I was in Latin America. I was doing a 3-city tour. Sao Paulo, Brazil on day 1, Santiago, Chile on day 2, and Lima, Peru on day 3. And I was talking about narrative and numbers, stories. So first day I'm in front of 300 Brazilians in a room, and I'm trying to think, I want to pick a topic where every person in the room is going to have an opinion. So if I were to pick a topic, 300 Brazilians in a room, what's the one topic where every person in the room is going to have an opinion? It's going to be soccer for 6 months before the World Cup. So I ask, is it possible that Brazil will win the World Cup? You ask 300 Brazilians 6 months before a World Cup, is it possible that Brazil will win the World Cup? What do you think the answer is? Of course, we won it 5 times before. I said, is it plausible that Brazil will win the World Cup? Now, if I'd asked this question in December of 2014, that room would have been a little shaky. This requires a little bit of World Cup history, but there was a World Cup in 2014. It happened to be in Brazil. Does anybody remember what happened in that World Cup? If you're Brazilian, you're trying to erase it from your memory, but there was this famous semifinal against Germany where there was like 7-1, 8-2, shellacking for the ages. Luckily, by 2017, they had completely wiped this out of their heads. They said, it's plausible. We have a pretty good team. We're ranked number 2 in the world. Then I said, is it probable that Brazil will win the World Cup? And now you could see the wheels going to motion. We're in the right group, and Neymar stays healthy, and he doesn't flip and flop and do whatever he does on the pitch. You can see with each one, you're upping the ante. Is it plausible? And I want you to do the same thing with your story. Is it possible? Make sure you're not telling a friend. Is it plausible? Is it probable? So let me take you through impossible stories, implausible stories, and improbable stories to make sure you're not falling into one of those. Let's start with impossible stories. You know what a fairness opinion is? When you do an acquisition in the US, you have to hire an investment banker to attest to the fact that the price you're paying is fair. It's one of the most useless kabuki dances of all time, because I've never heard of a deal not go through because you couldn't find a banker to sign off. So some of the most horrific mistakes in valuation happen in fairness opinions because people are trying to justify the unjustifiable. This is about 7 years ago when Tesla bought Solar City, one of the most hopelessly conflicted deals of all time. Now, to see why it was hopelessly conflicted, you know who the largest shareholder in Tesla is, right? A guy called Elon Musk. He was buying Tesla was buying Solar City. You know who the largest shareholder in Solar City was? A guy called Elon Musk. What a coincidence. Same name, same guy, actually, the largest shareholder. No, the CEO of Tesla was a guy called Elon Musk. The CEO of Solar City was a guy called Musk with a different first name. His nephew, his cousin, whatever it is. So Tesla knew it was going to get sued and wanted to get immunity against lawsuits. So the way you get it is you hire a couple of bankers, you pay them millions of dollars, and you get this legal opinion saying this deal is fair. It's an exchange offer, so both companies are different. So let's go on with the story. So Solar City hires Lazard, which is this historic investment bank that's been around in New York forever, and Tesla hires Evercore. I'm going to say some incredibly harsh things about Evercore, but I mean every word. So they hire Evercore, they pay them $8 million to do this valuation. And when you do a fairness opinion, it becomes part of the public domain. It gets filed. So I go through the filings, look for the bank, and I'm willing to cut all kinds of slack because I know bankers have to bend all the rules. So I look at Solar City, the valuation of Tesla done by Evercore. Because remember, in an exchange offer, you've got to value both companies.
So they come up with all these this projected numbers, and they get to year 10, and they project a 6% growth rate forever. Now, first reaction, what currency are you valuing Tesla in? Turned out to be in US dollars. You know what happens if you value a company in US dollars, use a 6% growth rate forever when the risk-free rate is 2 or 3%. This is an impossible valuation. And for this piece of crap, you get paid $8 million. There's no justice in this world. Okay? This is an impossible valuation. Here's another example, a company that grows and grows so much that it becomes bigger than the total market. My favorite example for this, about 10 years ago, somebody picked Netflix to value in this class. Netflix is always a fascinating company to value. So to the middle of the semester, I asked people to turn in their valuation for feedback. He turns in his valuation. He's projecting $600 billion in revenues for Netflix. I said, can you come in and talk to me? And he did. So I said, do you have Netflix? He said, yes. And I said, how much do you pay per year? And he said, about $100. I said, I'm seeing revenues of $600 billion. How many subscribers would you need to have to get to 600? He said, about, I don't know, I have to get a calculator. I said, you don't need a damn calculator. 600 billion divided by 100 is 6 billion subscribers. He said, I don't see where this questioning is going. I said, have some patience. I have a few more follow-up questions. I said, what is the population of the world? I don't know. What, 8 billion? Is there something I don't know? Maybe there's a law that's been passed that every man, woman, child, and pet has to have its own Netflix account. You're not allowed to share. He said, don't be absurd. I said, no one estimating 600 billion in revenues. You are. This is an impossible valuation. This is what happens. You let growth rates run amok and you let it project up. So take a look at your revenues in year 10, not in year 1, not in year 3, year in 10. Make sure you're not projecting out revenues that exceed the total market you're going after. I've seen valuations where people cut costs and they grow. It's feasible, right? Efficiency growth. They do it in year 1, year 2, then you get to year 10, and keep cutting costs. You got a problem, a math problem, which is you cut costs, your margins improve, your margins go up. Finally, they hit 100%. Once you get to 100%, there's nowhere to go. You cut costs to 0, there's no more efficiency growth. Impossible valuation. So impossible valuations, basically, there's nothing to debate. So don't even ask me whether your beta looks okay, your cost. You've told me a fairy tale. You can do whatever you want with the beta. Use a negative beta, risk-free rate that you've made up. Because in a fairy tale, anything can happen. So impossible valuations, check. What are implausible valuations? This is when you tell a story that at first sight looks like it cannot go through, but maybe you have a really good explanation. I'll give you an example. A company that grows without reinvesting. Now, normally it says that can't happen. But if you're an infrastructure company, you spent the last 20 years building toll roads, you can get growth for the next 10 years without reinvestment because you're living off past reinvestment. I'm looking for an explanation for what doesn't make sense. Or a company whose margins are much higher than the competition. And I ask you, well, what's keeping its margins up? And so I don't know. Then you have a problem. But if you tell me, look, it's because the government keeps the competitors up. I mean, I remember valuing a company called Almarai. It's a Saudi dairy and agriculture product company. Its margins were twice as high as the typical food processing company in the Middle East. And I was in Dubai and I said, well, how do they keep their margins so high? And somebody in the audience who was a Saudi analyst said, have you taken a look at who the largest shareholders in the company are? I said, I haven't, I should. And I did. And it turned out that the largest shareholders, somebody bin Saud, part of the Saudi royal family. There's your competitive advantage. Member of the royal family acting as protection against competition allows for higher margins. See where I'm going with an implausible valuation? What I'm looking for is a story you can tell me that explains away what doesn't look reasonable. So impossible valuations, you can't do that much, but implausible, maybe you have a very special company. And finally, with improbable, I'm going to introduce what I find very useful when I do valuation. I'm going to give away what I'm going to do when you send me your Excel spreadsheets to assess. I don't know most of your companies. So you're going to be picking companies. So I'm not going to be sitting there saying your 23% revenue growth should be 25%. I don't know what you think I know. I don't know the revenue growth rate for every company in the face. So when you put in a high revenue growth rate for your company, I'm going to concede the space to you and say, you know more about this company.
And if you think it can grow at 25% a year, okay. Then I'm going to check your reinvestment. Remember, that's the line item between your after-tax operating income and your free cash flow to the firm. And if you have high revenue growth, what should I expect to see in your reinvestment? High reinvestment or low reinvestment? I expect to see high reinvestment. I'm going to check your cost of capital. Remember, I said the median cost of capital for a global company is about 9 to 9.5%. Usually, when you have high growth and high reinvestment, you're probably also going to have high risk. High, I'm going to say, okay, that's consistent. I'm not saying it's correct, but it's consistent. Low, consistent. But if you have high growth with low reinvestment and a low cost of capital, I'm going to look for a reason. And that's what I'm looking in your story. Can you explain to me how a company can have high growth? Then maybe your explanation can be they've built up capacity, they have excess capacity. That's why the reinvestment is low. And they're providing a product that everybody needs. And that's why I'm keeping the cost of capital. So when you look at your valuation, you can do your assessment yourself. You don't really need me to do it. So I'll do it for anyway. But check your growth rate, your reinvestment and risk. And if they're not in sync, ask yourself, what is the story that I can use to explain that difference? So let me go back to my Uber story. My original Uber story was it's an urban car service company that brings in new users into the business and has local networking benefits. It was a very easy story to defend. Why? Because by 2014, Uber already succeeded in parts of the world. The Bay Area, for instance, they had very clear example on the ground that they were able to get car service business away from traditional taxi cabs. They were drawing in users. So every part of the story, I have an easy time defending. Now, could I have told a bigger story for Uber in June of 2014? Yes. But the bigger your story, the more you have to defend, because you now have to come in and say, this is why I think the company can do what it is. And that's a trade-off you have to think of as a founder. You can go for the biggest story you can, but you have more lines of defense to play. Or you can go for a story that's more defensive. My story was a defensible story. I'm not saying it's the right story or the wrong story, but it's clearly possible, plausible, and probable. Once in a while, if you're especially an investor, you will hear a story from a founder that you so want to be true that you're willing to suspend all questioning and belief. I call these runaway stories. And I'll tell you the pieces that go to runaway story. First, the storyteller is charismatic and likable. You want the storyteller to win. Second, he or she is telling a story about disrupting a business you've never liked. You always hated the business. They're going to disrupt that business. And to add some icing on the cake, they're going to make the world a better place while doing this. Kind of story. Let me tell you a story. You tell me whether you want this story to be true. It's about a 19-year-old who drops out of Stanford. What's the acceptance rate? Unless you're a synchronized gymnast or something and you got it through the side door, it's like -3%. You get into Stanford, you drop out. To start a new business, you're saying another geek starting another software business. Here's where the story gets interesting. This 19-year-old is not a man, but a woman dropping out to start a blood testing business. She's going to just, any of you guys like Quest Labs or whatever lab you go to? I hate the blood testing business. Here's how it works. You have to get a blood test. You got to call ahead. They say, well, we've got an opening in 16 years. Something closer. Well, there's something in 3 months. If you come at 6 a.m., you take it, because what choice do you have? You show up at 6 a.m., they make you wait. Why? They can. 2 hours later, the doors open, Nurse Ratchet from one floor of the cuckoo's nest come on, and you go in. They got 2 buckets next door. What is that for? Your blood. Why do you need that much blood? Just in case Dracula shows up, I guess. They extract 2 buckets of your blood. You crawl back to the car. You're anemic at this point. You've lost much of blood. Then you wait and you wait and you wait. And 3 weeks later, you call and say, where are my results? Well, they've been sent to your doctor. You have to make an appointment with the doctor, 6 a.m. You show up at the doctor, you wait 2 hours, you go in, and the doctor, after spending 20 minutes, says you're okay. But then comes the final indignity, which is 2 weeks later, you get a bill in the mail that this whole thing cost you $2,000. We hate this business, right? And this 19-year-old is going to disrupt that business. She's going to create a business where she's going to take 2 drops of your blood, not 2 buckets, but 2 drops in nanotainers. This already sounds incredibly fancy. And 45 minutes later, she's going to email you the results. It's almost like she's in the 21st century. And the whole thing will cost you only $50. And by the way, she's going to give away these blood tests for free, parts of the world where people can't afford it. You want the story to be true? Did I make up the story? Well, this, of course, is the true story of Elizabeth Holmes. Drops out of Stanford at 19, starts a company called Theranos that does exactly what I described. And did people want the story to succeed? Take a look. By the time you got to the middle of 2015, Theranos was priced at $9 billion. You should take out the value. Venture capitalists, pardon, some of the biggest names in the VC business were investors in the company. It wasn't just VCs who were getting excited. The Cleveland Clinic, one of the premier healthcare entities in the US, had said, this looks promising, this looks right. Walgreens said they were going to have a Theranos lab in every Walgreens. It looked like the entire establishment had bought it. If in the middle of 2015, you'd ask me what I thought about Theranos, my reaction is I don't know much about the company, it's privately owned. But given the fact that everybody sees, it's not just VCs, it's Walgreens, it's the Cleveland Clinic, it's something here. But if you're investing in a blood testing company, remember, this is not a social media company or an online, it's a blood testing company. As an investor, what's the big question you want answered before you put money in? Does the blood test work, right? You'd think somebody would have asked. I assumed somebody would have, and I was wrong because in October of 2015, a Wall Street Journal reporter decided to ask this question. Does the blood test work? And the answer was actually in the public domain, because when you're a blood testing company to run these tests, you got to go through the FDA. So you went to the FDA and said, has Theranos been approved for these 32 tests they claim on their webpage they can do with the nanotainers? And the FDA said, no, they've been approved for one of the 32. And he said, how come? He said, well, the tests are kind of noisy. And what's a noisy blood test? Trust me, you do not want a noisy blood test. Because here's what the results look like. You might be dying or you might not. Don't worry about it. Go home, we'll tell you in a few months, right? You want precise blood tests. So he wrote about this in the Wall Street Journal saying this is a company that claims to do 32 tests, but it's been approved for only one. The company threatened to sue the journal. You've probably seen have you seen the miniseries on, so, and of course, in the next 6 months, a whole company, it turns out that they'd been cooking the books and that the nanotainers did not work. The $9 billion very quickly went to zero. Elizabeth Holmes was banned from the blood testing business. She moved to San Diego, a few blocks away from where I live. So I see her I used to see her once in a while. Then she, of course, got convicted of a crime. She's now going to go to prison. So this doesn't end well. But if you think about the ingredients here, you can see why it happened. In October 2015, I actually wrote about Theranos. And the question I was asking was, now everybody in hindsight said, I'd have seen it coming. And I said, really? I mean, June of 2015, Elizabeth Holmes was one of the most celebrated business women on the face of this earth. I remember she came to New York to give a talk. There were about 1,000 people in the audience. They brought their daughters because they wanted to see that it didn't have to be a social influencer to actually be a successful. She was, I think, the first business woman under the age of 30 to become a billionaire. I said, would you have had the courage to go to that meetings? You're surrounded by 999 other people who celebrate this person. Would you have had the courage to put up your hand and say, does your blood test work? You'd have felt like the guy who shot Bambi's mother. I just felt badly for that guy. You ever thought about this guy? Bambi, you've never seen Bambi, you have no idea what I'm talking about. But the movie starts with Bambi's mother being shot in the woods. That must have gone through psychology and psychiatrists were strong. My point is when you face these stories that build up their momentum, it's very difficult to be the person who raises the tough questions. So often you get the self-selection bias where people feed in. So the same phenomenon with WeWork, right? Adam Newman's company, how can you file in? And of course, Marcel Son leading back. But basically, with these companies, the unraveling begins because something goes wrong. So these runaway stories, what usually happens that causes stories to break apart is some point in time you start to lose trust.
in the storyteller. And then once you lose trust in the storyteller, then you recognize the story they've been telling is at war with numbers. You say, why did it take so long? Because as long as nobody's asking questions, as long as you're in the bubble, the price gets pushed down. And with WeWork, if you get a chance, go back and read my post on WeWork, where essentially at the time that it went public, Goldman Sachs was estimating a pricing of 90 billion for the company. Why? Because Master Son had it at 48 billion. So their reasoning is Master Son is a smart guy. If he's paying 48 billion, it must be worth at least twice as much. It's simple as that. And in a period of 8 weeks, the company's pricing went from 90 billion to zero. Shows you how quickly these stories can unravel. But that's really what you're checking against, is to make sure that you're not one of those runaway stories.
Staying on the theme of impossible, implausible, and improbable, there is also variation on implausible stories that might not be at the company level, but it might be at the market level. Let me explain. Let's assume you're looking at a big market, AI, the cloud business. What happens when you have a big market? You have people who think they can make money in the market. So let's say you come up with a product or service for this market, and you think you can conquer the market. So what do you need to do? You need to go find investors who might buy into your story. So find VCs. Now, if you think about the pieces that go to the puzzle, let's suppose you're one of those entrepreneurs and you think you can go after this market. Now, I'm going to ask you the generic characteristic of entrepreneurs, and you can choose not to answer the question. Are entrepreneurs tend to be shy, diffident people, or overconfident? You've got to be almost overconfident to be an entrepreneur, right? So you're overconfident because you think you can conquer that big market. You go after VC. Venture capitalists tend to be diffident or overconfident. They think they can pick winners. So the 3 venture capital invest in you. So you now have a group of 5 or 6 overconfident people thinking you can conquer this big market. How does it show up? When you project out revenues and market share, you project out high revenues and high market share because you're convinced that you're going to be the winner. And while you're doing this, there are 100 other clusters in Silicon Valley all doing exactly the same thing. Probably in offices up and down the same building. There are 7 people thinking into that. Let's see what the end result of this is going to be. Each cluster thinks it's being rational. But if you add up all of these clusters together, it's almost guaranteed that the collective market you're going to get is going to be far bigger than the actual market. It happened in the .com boom. It happened with online advertising. It's happening right now with AI and cloud business. And guess what? It will continue to happen as long as we have markets and we're going after what we see as big opportunities. I call this the big market delusion, which is there's a big market, therefore companies should be worth a lot. You're seeing this with the electric car business, right? At least until a couple of years ago. Lucid got pushed up, Rivian got pushed up, Tesla got pushed up. Why? Because there's a big market out there. You saw this with China as a market 10 years ago. Every company going to China saw its pricing pushed up because it's a big market out there. It's a variation on the implausible story, but it's a variation that shows up only when you get everybody into the room and you recognize that each person is making the projection that collectively can't hold true. Doesn't mean that all of these companies are losers, but it does mean that collectively these companies are going to be overpriced because people tend to be overconfident. Overconfident people start these businesses and price these businesses. In fact, what you see here is the online advertising business. This was in 2015. What I did was I took the market cap of every company that made money in online advertising, and I reverse engineered from the market cap what the revenues would have to be in year 10. You can do this with your own Excel spreadsheet. You can solve for what the revenues in year 10 have to be to give you the market price today. I did this with every company. Then I added up all the numbers. And the number that I got across all of the companies, the projected revenues, was 682 billion. You say, so what? The collective advertising market in 2015 was about 450 to 500 billion. I was actually projecting the collective revenues in the companies that I was looking at to be greater than the total market. This is that it's an impossible, if you collectively, it's impossible valuations. Individually, each valuation can justify, but you can see in collection what's going to happen. So the next big market, you can see already the seeds. The cloud business was there a few years ago. It's starting to fade. Now it's the AI business. Who knows what the next big business will be. You can see this phenomenon play out. This is the bad thing.
This is the definition of a bubble, right? You're creating a bubble because you see a big market, and then the bubble bursts and you get reality check. I actually wrote a piece that actually got me a bit of pushback. I go, what's so wrong with bubbles? What's your turn? Would you want to live in a world run by actuaries? We'd still be in caves. They're saying this fire thing, too dangerous. Let's think about it for a few more thousand years. Maybe one of these days we'll get out of here. Every human advance has come from human beings overreaching. That's what a bubble is. People overreach. The dot-com bubble bust, right? But it changed the way we live our lives. When was the last time you actually went into a travel agency? You guys don't even know what a travel agency is, right? There was a time when you wanted to book a flight, you actually had to go into this office and talk to this person behind the desk who had this magical access to what the flights would look like. And they would get you the right flight and you pay them a few $100s for this privilege. Hey, let's face it, the dot-com boom and bust changed the way we live. Online advertising changed the way we live. Artificial intelligence might change the way we live, but that doesn't necessarily mean that every company involved in the space is going to make money. We need to stop mistaking big markets for big valuation for every company in that market. But the Cathy Wood problem keeps recurring, right? But because that's basically the core of why Cathy Wood's stories don't sell is based entirely on a big market. So there's a big market, therefore the company has to be worth a lot. That's not enough. One final example of the kind of delusion that can drive valuation. Remember the valuation triangle I talked about? Now, one of the companies that, you saw my Tesla valuation in 2020, 2023. But Tesla is a company I've been valuing right from the beginning. This was a 2013 valuation I did of Tesla. I came up with what I thought was a pretty upbeat valuation at that time. But Tesla at that time was also one of the most widely touted stocks on Wall Street. So after I finished my valuation, I come up with the value of $150 per share. I see an equity research report from this well-known equity research analyst tracking Tesla, and he's come up with $600 per share. And as I opened up this page, the equity research report, it's like 200 pages long. But I finally find this one exhibit with the cash flows and revenues, because I want to see what this analyst is projecting for the company that's giving him a value 4 times higher. So first thing I check is revenues. Maybe his revenues are much greater, and his revenues are actually a little lower than mine. This is strange. Maybe his margins are much higher. So check his margins, and he had done EBITDA margins, and his margins were roughly on par with what I was forecasting. But his revenues are roughly less than what I'm projecting. His margins are about the same. So why is his value so much higher? So I take a look at what he's reinvesting. And the easiest way to do this is see what he calls his unlevered free cash flow. That's really free cash flow, the firm. No, it's just a different word for free cash flow. And there's his net income, which is like an after-tax operating income. I looked at the difference between those two numbers. So all these intermediate line items are his reinvestment. So I added up his income for the next 15 years and his free cash flow for the next 15 years. The difference between those two numbers is what he's reinvesting. And I had a problem because over the next 15 years, which was his time horizon, he was reinvesting almost nothing. Now take a look at the top line. That's the number of cars he expects Tesla to sell. It's going to go from 24,000 to 1.1 million. First, let me pause right there. Is it possible that Tesla can sell 1.1 million cars? It's a big market. It's 85 million cars, 1.1. Is it plausible? Is it probable? I can pass all those tests. But here's the problem. That in 2013, Tesla had one plant in Fremont. That was their only plant with a capacity on a good day of 20,000 cars. We have a problem. So I called the equity research analyst. He was actually in an airport on his way to California. I think he was going to worship at a Tesla shrine somewhere there. And I said, look, I've been looking at your equity research report. There are some questions about your D.C.F. That's what he called this, is D.C. I decided to stay with him. He said, I can't answer those questions. I said, why not? He said, well, I don't do the number crunching. I said, I have a team. I said, you have an entire team that turned out this team of 6. He said, can I call the team? He said, yeah, next week we'll all be together. You can call. So I called him a week later. The entire team is gathered around. So lead analyst comes on and he says, look, I don't do any of the numbers. I said, what do you do? He said, I schmooze. I talked to management, I talked to people. I said, okay, what's your second in command do? He said, secondary schmoozer. I go with this guy when he schmoozes. The third guy was the backup schmoozer, one of the two does. I said, who among you doesn't schmooze? And they point to this young 23-year-old hired at a ward in the previous, he's the guy. Put in front of him. So I take him through, and he very quickly, bright kid, he very quickly sees the problem. And he said, you know, what happened? And he said, it slipped my mind. I said, what slipped your mind? He said, putting in the reinvestment. I just took last year's capex and depreciation and just projected it out. In other words, he was doing what Trading the Street teaches you to do, right? Take the Excel spreadsheet, project numbers out. And in the previous year, capex had been very close to depreciation. He projected the numbers out. And I said, do you see what the problem is? You have a capacity of 200,000 cars. You're projecting sales of 1.1 million cars. He said, what should we do? We can't tell the word. We slipped our minds. I gave him a suggestion that he did not take. My grandson is very fond of this movie called Willy Wonka, the original Willy Wonka and the Chocolate Factory. Have you seen this? One of my favorite movies of all time. I said, have you ever seen this movie? The analyst, the 23-year-old hadn't seen it, but the older analyst had. And I said, well, one of the things that always puzzled me about the movie is there's one factory, very inefficiently laid out factory, like chocolate rivers running through it and stuff, which churns out these chocolates that are sold all over the world. And when I came out of that movie, when I was younger and I saw the movie, my big question was, how does this one factory have the capacity to produce all these chocolates? And the answer is actually in the movie. There are these mythical creatures called Oompa Loompas. You get a chance, go on Google and look, type of the word Oompa Loompa, and they dance and they sing, and as they dance and sing, chocolates come flying out of the factory. I said, that's what you need to do. Put out a press release that Tesla has replaced their entire workforce with Oompa Loompas. You know, then you can have 200, who cares, 200,000 capacity can become 1.2 million. He didn't take my advice. But I call these Oompa Loompa valuations, or you prefer Willy Wonka-itis, basically whatever you want to call it. You'd be surprised how many valuations you see where people project out growth, but they don't reinvest to generate growth. There's no free lunch. You've got to set aside the money if you want the growth rate. Otherwise, something can break it. So is it possible? Is it plausible? Is it probable? Let me return to my Tesla story. I'm now going to take my story and convert it numbers. What did I describe Tesla as? An urban car service company, right? So what's the market it's going to go after? The urban car service market. How big is it? Nobody knew in 2000. I looked everywhere. And finally, the reason nobody knew was this entire market was splintered. It was run by taxi cabs in different cities. So here's how I had to come up with the market size. I had to go city by city, taxi and limousine commissions are their equivalents. Now, New York City is a taxi and limousine commission. They have an estimate of what the taxi cabs made in 2013. And I did this for about 50 cities. I was able to get it. I came up with a total market of about 50 billion for those cities, and then I doubled it. Why? Because the remaining cities are tough. Nobody had any idea. I put out an estimate for the total market of 100 billion. Could I be wrong? Absolutely. But to show you why Google search can get you into trouble, a year later, I go looking for size of the urban car service market, hoping that a better estimate shows up. Guess what shows up as the number one find? 100 billion projected by the motor. Somehow it's become this total market size that if they only knew how I did this and how many pieces I had to guess, they wouldn't be so sure about the number. So I'm saying don't trust market size on that you might find on Google search because it's somebody's guess. And you might have to second guess, triangulate, make sure. But that became the entire. That market had been growing at about 2% a year. I let it grow at 6% a year. What does that allow for? It basically allows for the fact that new customers are going to be able to enter. So I'm taking each part of my story and making it up. I gave Uber a 10% market share, but I capped it at 10%. 10% was a huge market share for a business where it would be incredibly splintered, right? What's the largest taxi cab company in the world have? 0.1% market share. I'm giving Uber 10%, but I stopped at 10%. Why? Because in my story, there are local network competitors, and there are going to be a dozen different ride-sharing companies controlling different parts of it.
I did give Uber an operating margin of 40%. Why? It's an intermediary business. In steady state, once they stop giving you promotions, they should have pretty high margins. Because they don't own the cars and they don't essentially have any capital intensity, adding another city for Uber is almost costless. The way this showed up is I gave them a sales to capital ratio that was twice as high as a typical company in the market because they don't need to reinvest much to grow. Essentially, I've taken each part of my story and made it to a number. Now, to do a discounted cash flow valuation, I do need a discount rate, right? You know how much time I spent on the discount rate for Uber? Only 3 minutes. This is not what's going to make or break my valuation. I'll tell you what I used as my discount rate. Rather than go through a beta, cost of data, cost of equity, and cost of capital, which is what we talked about for how many sessions. I went to a histogram of cost of capital. Histogram basically is, I broke down every global company. And I have a histogram for this year. You can see what the median is, what the 10th percentile is, what the 9th. I went to the 90th percentile. And I said, it's a risky company. Rather than finessing the cost of capital, I'm going to give it the cost of capital of a risky company. And in 2014, that cost of capital was 12%. That was the 90th percentile. And is there a chance we will not make it? Remember, it's still a money-losing small company with the potential regulatory rollback. So I did allow for a 10% chance of failure. Every number in my story is now, every part of my story is now a number. Revenue growth, margins, reinvestment, cost of capital. So this is my final valuation. It looks like an Excel spreadsheet, but if you point to a number, you're going to ask me, why is your number what it is? I'm going to respond with this story. So you ask me, why are my revenues 3.6 billion in year 10? Because Uber is an urban car service company with local networking benefits. Why is my reinvestment so low? Because they don't own the cars and they don't hire the drivers. That should be the way you think about responding to questions about inputs in your valuation, is a story that justifies that number. The end valuation that I got from Uber with the failure rate built in was about 6 billion. What is the Wall Street Journal story that attracts my attention to Uber in the first place? The VCs had priced it at 17 billion. I put this up at 3:30 on Friday afternoon. 3:45, I get a call from a Wall Street Journal reporter. He said, I noticed you've written a piece on Uber. I said, thank you for noticing. She said, I also noticed you estimated a value of 6 billion for it. I said, you're very observant. She said, you do know that venture capitalists have valued the company at 17 billion, almost corrected her there, but you know what I'd have corrected, right? They don't value companies for pricing. I decided to cut her some slack. She's a journalist after all. I said, yes. She said, so how do you explain the 17 billion? They said, I don't have to explain it. I didn't pay it. I've never felt the urge to explain what other people pay. Don't try to do it. It's just a lifetime of frustration. So if somebody asks you, why is somebody paying 23,000 for Bitcoin, unless you're the person who paid it, don't feel the urge to explain it. People who pay whatever they want. So the final question, are you telling me they're wrong? I said, I'm doing nothing. I'm saying with my story and my valuation, I won't invest in Uber. But maybe they have a bigger story. We need to talk. Every valuation reflects your view, your story. It's not the story, the valuation. It's your story and your valuation should drive your decision. And that's the way I like to think about your valuation. It's not. So don't ask, is this the right valuation? The question you're asking, is this the valuation that I can base my decisions on? Because that's all you can do. You cannot tell the rest of the world what to do. Make the best of it. So I'll see you on Wednesday.